European Central Bank President Christine Lagarde walked me through her thinking on why she cut interest rates by 200 basis points over the last 16 months, while the Federal Reserve had not. What are your plans for the coming years? There have been lots of speculation that you would ultimately run for president of France. Is that still an ambition of yours?
Well, there's a good president in France at the moment, called Mr. Emmanuel Macron, and he has a job until May of 27. And I have a job, which is an important job until 27. Yes, that's right. So we'll see. I've never made any plans. I'm not going to make any plan now.
I know the World Economic Forum also wants you. Were you thinking seriously about that as well?
It's an institution that I have liked, respected, participated in, and it's one of the many plans. But I don't have plans. Plans will turn up. It's been my life.
Well, you are now at the wheel at the ECB, and you have been very direct, and you have been very communicative with the market, with your policy. I want to get your take on the macro story. What has been the impact on Europe as a result of this war and overall the economy slowing across the world? What can you tell us about the macro story right now within Europe?
Let me tell you the phases that we went through, because we went through 3 successive phases. We had to, first of all, hike rates significantly, and then we had to hold rates, and then we had to cut. And that was always predicated on the state of the economy, on the inflation risk, and on inflation expectations. And, my 3 key compasses, if you will, are those: the economic outlook, the underlying inflation, and the channel of transmission of our monetary policy. And it's really driven by those 3 key compasses that we have determined our monetary policy over the course of the last 6 years. And it's been a roller coaster, really.
So do you expect growth now at this point throughout the Eurozone? Walk us through what the economy there looks like.
Okay. At the moment, the economy, as I said earlier, is resilient. So it's not thriving because it has gone through so many shocks and it has traveled a period of high uncertainty. So the growth expectations we have for 25 is a small 1%. And probably the same thing next year, and then increasingly back to potential. So the growth is relatively modest, but resilient and on its way up, with the fundamentals such as consumption and investment looking good at the moment. In terms of jobs, we are at record low unemployment and record high employment participation. So this is good. And inflation, I'm pleased to say that we are at target. So the latest readings are 2%, and our medium-term inflation target, which is what really drives our action, is at 2%. So I would say on the inflation front, we have really addressed all the issues of the past, the shocks that we faced, and we are in a good position. There will be more shocks, we know that, but we are in a good position.
Well, what do you want to say about regulation as it relates to growth? Because no doubt you are aware of the Mario Draghi report from a while back, where he talks about competitiveness. And he writes about the fact that we have not seen the kind of market gains, the kind of market values for companies that we have in the United States. I mean, right now in the United States, we've got at least 5 companies that are valued at $1 trillion or more. We've got a couple of companies that are $4 trillion. The highest valued company in Europe right now is about $300 billion. Why do you think that is?
I think, first of all, that is the case. Second, I believe that the reasons identified by Mario Draghi in his report are correct. Lack of competitiveness, excess of regulation, duplication of efforts between the member states, and essentially it boils down to the single market of 27 member states has not accomplished its ultimate goal, which was to have a single market. And if we can pursue the single market by removing many of the barriers that we have, and if we can improve competitiveness by removing not scaling down regulation, because we need a framework, we need rules, we need some protection, because otherwise it's, the rule of the jungle. The biggest guy wins and all the other ones are left to lose and to suffer. This is not the way in which we should operate as societies, but we shouldn't have too much of it. So the goal is to simplify, to have a real single market, and more importantly, to have capital market union. We need money to be invested in Europe. At the moment, there is plenty of savings, but there is not enough investment. So we want those savings to be invested in Europe.
How do you lure big money countries, investors, individuals, whatever, into Europe? Because when you look at the broad situation right now, isn't it true that much of the innovation and growth is coming from the United States? Whether it be crypto, whether it be artificial intelligence, all of these things that companies are grabbing onto to actually trigger their own individual growth.
So on some of those sectors that you mentioned, it's clear that the United States is way ahead of the game. Not in all sectors. If you look at green innovation, for instance, Europe is leading the pack. But we have to catch up, and we have to do a lot more. But to do that, you need the talent. There are talents in Europe, and they tend to export themselves to the US quite often, but we want to keep them there. And there is a need for equity. And if you don't manage to keep the savings invested in Europe, or to attract savings from somewhere else, because you have a safe environment, because it is stable, and because there are prospects for growth because of a simplified environment and a single market of 450 million people, well, it's got potential, but the political drive to implement all that has to be demonstrated.
Well, look, while we say that these innovations are coming from the United States, it must be said that when it comes to monetary policy, the ECB is leading the world. And you have made very important decisions over the last 2 years. You've been very methodical about those positions. You've cut interest rates by 200 basis points in the last 16 months. You told the market exactly what you were doing and why you were doing it. Tell us why you took such an aggressive stance while the Federal Reserve has not been doing that. I mean, it used to be that the Fed would set policy for the world. Now you're doing your own policy. You're not following the Fed. In fact, now the Fed may be following you and cutting rates next month.
I think each of our economies has its own specificities. The European Union was massively exposed to shocks and risks that the US was not exposed to. We had inflation expectations that were of a different nature. So it's a different piece of work. It's a different game, and each of us has to be focused on the characteristics of our respective economies. What we did is really be completely driven by the data, the facts, the figures, what was being delivered by the economy, so that we could tell how our action would be most efficient in order to do one thing: deliver on our mandate. If I was obsessed with one thing, it was that. We have a mandate, it is price stability, and we just have to be focused single-mindedly on that. And that's what we did.
I mean, it's interesting about the mandate, because the Fed has its mandate, unemployment as well as inflation. And yet the president has been critical of the Federal Reserve, partly because of the cost of holding the debt. The United States facing $37 trillion in debt. It is costing the U.S. more to carry that debt, interest payments, than the U.S. is spending on defense. And so that's part of the reason. Shouldn't, whether it's the ECB, the Fed, shouldn't the debt also be considered in terms of that mandate? Or you just stick to the mandate and there's no looking outside of those barriers?
I think we should stick to the mandate. That's what we have to do. That's what, for us, it's pretty simple. There is a treaty that established the European Union, which very specifically says that this is the mandate of the ECB, price stability. Now, of course, when we analyze the macro environment, we have to take everything into account. But the mandate and the goal that we must keep our eyes on is price stability.
What is your reaction to Jay Powell's speech today, which, of course, sparked a big gain in the stock market and has most people expecting that the Fed will now cut rates next month?
I thought his speech was very balanced. It had two parts. One was the current analysis of the situation. The second was the presentation of the strategy that they have conceived for the next 5 years, which was very clear and straightforward. And I could see some analogy between what we have decided in our strategy review and what the Fed has decided as well. And in terms of describing the economy, I think he has had a very, very balanced approach to all the factors that he has to take into account.
Do you feel that the independence of the Fed has been, impacted by these last few months?
I think the independence of any central bank is critically important. I think we have to be accountable. We have to report back and to answer all the questions of either Congress in the US or the European Parliament for me. But it's vitally important that central bank is independent. You know, in my IMF days, I have seen close hand what happens when a central bank stops being independent or when its independence is under threat. It becomes dysfunctional. It starts doing things that it shouldn't do, and the next step is disruption. It is instability, if not worse. So I think that it should not be debated.
I understand that, and I'm with you on that. But I wonder if the critics are onto something when they say maybe the Federal Reserve already violated its independence by, as soon as Jay Powell got into office, he came up with all of these climate rules and
no.
DEI rules. Oh, they did.
No.
They did. They said they wanted to have a mandate, but then he also put climate rules and regulations in place and DEI regulations, and then cutting interest rates 2 months before an election, and then after an election when Donald Trump won, saying, "Oh, never mind, I'm not going to continue cutting. I'm focused on inflation now."
You know, on climate change, I disagree with you. I really disagree with you because as part of our mission, the ECB must do supervision of the banks, right? It's a separate umbrella, but it's part of the ECB. And in the supervision of banks, it is our duty to check the climate change risk to which banks are exposed. You know, if I have a mortgage on a house which is located by the ocean line, and there is a risk of flood, or there is a risk of that house never being insured again, it has to be taken into account in the balance sheet of the banks. So that is risk management at its basics, and we are doing that at the ECB. I think the Fed has been very, very much on the fence in relation to climate change, and I wouldn't say that the Fed has been actively participating in any of our debates on climate change, including from a risk management perspective.
By the way, do you have any reaction to this mortgage fraud allegation of one of the Fed governors, Lisa Cook?
No.
Well, she wasn't going to touch that, Ashley Davis, on the mortgage fraud allegations from Bill Pulte.
Absolutely, Maria. You know, I am a huge fan of what Bill has been doing. But listen, we need to see, obviously this has gone to the Department of Justice. We really need to see right now if it's something that's going to materialize into something else. If it does, it's a serious problem. And also, you know, there's going to be many other people that he's going after as well. But I love it.
All right, stay with us. We got part 2 of my exclusive with Christine Lagarde. We are just getting started this hour.